When you deposit your paycheck into your savings account, what do you think happens to that money? Most of us have this comforting mental image. We imagine our cash sitting in a digital vault, safe, secure, and waiting for us to swipe our debit card. We think of the bank as a storage facility, a high-tech locker for our hard-earned wealth. But here is the truth that the banking industry doesn't advertise. That vault? It's mostly empty. The moment your money hits your account, it disappears. It's sent out to work. But it's not working for you. It's working for them. Today, we are going to tear down the facade of modern banking. We're going to look at the mechanics of how a deposit of $1,000 from you can turn into $10,000 of lending power for them. We're going to explain the net interest margin, the magic trick known as fractional reserve banking, and the hidden fee structures that ensure the house always wins. By the end of this video, you'll never look at your savings account statement the same way again. My name is Leo, and today we break down complex financial systems so you can make smarter decisions with your money. Let's start with a fundamental shift in perspective. You need to stop thinking of a bank as a service utility like the water company or the electric grid. A bank is a business. Specifically, it is a business that buys and sells money. When you deposit savings, you are the supplier. You are selling them your cash. The price they pay you for that cash is the interest rate, the annual percentage yield, or APY. When they lend that money out for a mortgage or a credit card, they are selling that money to someone else. The price they charge is the interest rate on the loan. The gap between what they pay you and what they charge the borrower is the profit. It sounds simple, right? But the scale at which this happens and the specific mechanisms they use to multiply that profit are incredibly sophisticated. In this video, we are focusing on the three pillars of bank profitability: the spread, the multiplier, and the fees. Let's start with the most direct way they profit from your patience: the spread. In the banking world, there is a metric called net interest margin, or NIM. This is essentially the difference between the interest income a bank earns from lending and the interest expense it pays to depositors like you. Let's look at the numbers, because this is where the disparity becomes shocking. As of right now, many traditional brick-and-mortar banks, the big names with branches on every corner, are paying roughly 0.01% to 0.5% on a standard savings account. If you are generous and give them $10,000 to hold for a year at 0.01%, they will pay you exactly $1, one single dollar, for the privilege of using $10,000 of yours. Now, what do they do with that $10,000? They turn around and lend it. Let's say they lend it out as a personal loan. The average interest rate on a personal loan might be around 10% to 12%. If they lend your $10,000 at 10%, they earn $1,000 in interest that year. They pay you $1. They keep $1,000. They have effectively marked up the price of your money by thousands of percent. Even if they lend it out as a mortgage at a lower rate, say 7%, they are still making $700 off your money while paying you that single dollar. This is the low-cost funding model. Deposits are the cheapest source of capital for a bank. If a bank had to go to the open market or the central bank to borrow money to lend out, it would cost them significantly more. But you give it to them almost for free because you value safety and convenience. Bankers used to joke about the 3-6-3 rule. Pay depositors 3%, lend it at 6%, and be on the golf course by 3 p.m. Those days are long gone. Today, thanks to data analytics and consumer inertia, basically our laziness in not switching banks, they can pay depositors nearly zero while charging borrowers market highs. But here is the kicker. You might think, okay, so they lend out my $10,000. That's fair. But they don't just lend out your $10,000. They use your money to create new money. This brings us to the most misunderstood concept in finance. This is where things get technical, so stick with me. This is the engine of the modern economy, and it's how banks supercharge their profits. It's called fractional reserve banking. The definition is in the name. Banks are only required to keep a fraction of your deposits in reserve. They can lend out the rest. Let's walk through a simplified example to see how this multiplies money. Let's assume a reserve requirement of 10%, meaning for every dollar you deposit, the bank must keep 10 cents in the vault and can lend out 90 cents. Step 1. You walk into Bank A and deposit $100,000. The bank keeps $10,000 in the vault and lends $90,000 to John to buy a house. Step 2. John pays that $90,000 to the seller of the house, Sarah. Sarah takes that check and deposits it into Bank B. Now, Bank B has a new deposit of $90,000. They keep 10%, $9,000, and lend out the remaining $81,000 to Mike to buy a car. Step 3. Mike pays the car dealership, and the dealership deposits that $81,000 into Bank C. Bank C keeps 10%, $8,100, and lends out $72,900. Do you see what is happening? Your original $100,000 is still listed in your account. You can withdraw it. But Sarah also has $90,000 in her account. The car dealership has $81,000 in their account. From your initial $100,000 deposit, the banking system has created hundreds of thousands of dollars in new commercial money. And guess what? The banks are collecting interest on all of those loans. Bank A is collecting interest on the $90,000 loan. Bank B is collecting interest on the $81,000 loan. Bank C is collecting interest on the $72,900 loan. They are earning interest on the same initial capital multiple times over. This multiplier effect is why banking is so profitable. They aren't just the middleman. They are the creators of credit. When you leave your savings in a low-interest account, you provide the fuel for this entire engine, while receiving almost none of the benefit. But wait, there's more. Because sometimes the bank makes money simply because you made a mistake, or because you didn't read the fine print. If the net interest margin is the cake, fees are the icing. And for many banks, the icing is incredibly thick. Non-interest income, revenue that comes from fees rather than lending, is a massive part of a bank's profit model. They have engineered their accounts to penalize small savers and the financially vulnerable. Let's talk about the overdraft fee. This is one of the most controversial revenue streams in the industry. If you have $50 in your account and you buy groceries for $55, the bank could decline the transaction. Instead, many will approve it, cover the extra $5, and charge you a $35 fee. Think about the math on that. They lent you $5 for a few days and charged you $35 for it. If you calculated that as an annual interest rate APR, it would be thousands of %. It is effectively predatory lending disguised as a service. Then there are monthly maintenance fees. Many banks charge $12 to $25 a month just to have a checking account unless you maintain a minimum balance or have direct deposit. They are charging you to hold money that they are already using to make loans. It's a double dip. They make money on the spread and they charge you rent for the account. Finally, there is cross-selling. When you walk into a branch to deposit a check and the teller asks, "Do you have a credit card with us?" or "Have you looked at our investment services?" That isn't polite conversation. That is a sales script. Banks use your savings account as an anchor. Once you are a customer, they have your data. They know your income, your spending habits, and your debt levels. They use this data to sell you credit cards, insurance, and wealth management products. The savings account is often a loss leader or a low-margin product designed to get you in the door so they can sell you the high-margin products, like a credit card with a 25% interest rate. They want to be the one-stop shop for your financial life because the more products you have with them, the harder it is for you to leave. This is called stickiness. There is one final layer to this mechanism that you need to understand. It's not money the bank takes from you directly. It's money you lose by staying in their ecosystem. If your bank pays you 0.01% interest, but inflation is running at 3%, you are guaranteed to lose purchasing power every single year. By keeping your emergency fund or life savings in a standard, low-interest checking or savings account, you are effectively paying a tax to the bank. You are accepting a guaranteed loss in real value in exchange for the illusion of safety. The bank knows this. They rely on lazy money. They count on the fact that you are too busy to move your money to a high-yield savings account, HYSA, or a treasury bond. Every day your money sits idle in a 0.01% account. The bank is winning, and you are losing. So, the system is rigged to maximize their profit, not yours. They take your deposits, multiply them through fractional reserve banking, lend them out at high rates, pocket the spread, and charge you fees for the privilege. But knowing the mechanics is the first step to opting out of the bad deal. You don't have to accept 0.01%. There are online banks and credit unions that operate with lower overheads and pass those savings back to you in the form of high-yield savings accounts, often paying 4% to 5% or more. That is 400 to 500 times what the big banks pay. You can opt out of overdraft protection, so you never get hit with a surprise $35 fee. You can move your lazy money into short-term government bonds or index funds to beat inflation. The bank is a business partner. If a partner was taking 99% of the profit and doing none of the saving, you'd fire them. It might be time to fire your bank or at least renegotiate the terms. If you found this breakdown helpful, hit that like button. It helps the algorithm show this truth to more savers. And let me know in the comments, what is the most ridiculous fee a bank has ever charged you? I read every comment. Don't let your money be lazy. Make it work for you. Thanks for watching, and I'll see you in the next video.